investment transactions typically involve two parties. There's an investor and an investee. The investee is the corporation that is having its shares or its debt purchased by some other corporation. In this case, the investor. The equity method of accounting is tracking the equity inside of the investee. Before we look at a numerical example, let's just remember where we are from the flowchart going back to example 16-1. Let's take a look. This is the flowchart that we looked at in the prior video. There's a particular path I'd like to focus on in this video. So recall, we start off with any investment asking ourselves if the investor intends to hold that investment for less than a year. If the answer is no, that means the investor intends to hold the investment for more than a year. We then take a look at the percentage of ownership with respect to the shares that have been purchased. If the investor has purchased between 20 to 50% of the outstanding shares of the investee, we would use the equity method of accounting. And we can zoom out and see that that's where all of that fits into the big picture of things. Now, the equity method of accounting really is talking about, does the investor have significant influence over the operations of the investee? So a lot of times it's not enough just to know what percentage of shares have been purchased. We also need to consider things like, does the investor have representation on the investee's board of directors? Does the investor participate in the decision-making and policy-making process of the investee? Are there material transactions between the investor and the investee? And the investee's common shares, are they held by many shareholders or are they concentrated amongst just a few? For example, if the investee has got one 80% shareholder, then if the investor buys 20%, they don't really have significant influence, do they? The other shareholder has all of the say in everything that occurs. But let's say that there is significant influence and we're going to use the equity method. What do the journal entries look like in a situation like that? Let's take a look. This is example 16-2. And in this example, Valley Ocean Inc. made a significant influence investment in 20X1. We are required to record the journal entries for each transaction below. On December 5th, they purchased 2 million shares of EQTY Limited for $3.50 a share. So EQTY would be the investee. EQTY Limited had 10 million shares outstanding at the time. We could quickly do some math here. If we were to take 2 million and divide it by 10 million, we would get 20%. So we're right within that threshold of where we need to consider the equity method. We are told in the background that they did make a significant influence investment. So I think we're safe to use the equity method here. The purchase of 2 million shares for $3.50 shares can be done as follows. We can debit the investment account, debit investment in EQTY Limited common shares. Another account that is sometimes used would be debit investment in associate and then a hyphen EQTY Limited. We'll do it this way in this example. We'll take the 2 million shares and multiply that by $3.50 for $7 million. We'll then credit cash for the same amount. Moving on to the next transaction. Received a cash dividend of a penny a share on the EQTY Limited shares. So in the equity method, we would receive the dividend by debiting cash if it's a cash dividend. Remember, we have 2 million shares multiplied in this case by a penny a share. That totals $20,000. And the account that's credited is actually the investment account. We'll debit investment in EQTY Limited common shares. Or if you've used an investment in associate account, you would credit that account. We'll credit the account for the same amount. So what's happening here? We set up an investment account in the first transaction, and now we're reducing the investment account in the second transaction. And this occurs because we are tracking the equity in the investee. For a moment, you don't need to do this, but let's just take a look at what the investee would have done here. The investee, when declaring a dividend, they would have debited their retained earnings account. And the investee, we know, had 10 million shares issued and outstanding. And if they were doing a penny a share dividend, they would have debited retained earnings for 100,000. They would have credited dividends payable, and then when they paid, they would have debited dividends payable and credited cash. So here's the net entry of what the investee would have done. They would have debited retained earnings and eventually credited cash. Taking a look at retained earnings, the investee's retained earnings has decreased. And if their retained earnings has decreased, and if we are keeping track of their changes in equity, what would happen? Well, we could take the 100,000 decrease in equity and multiply it by our percentage of ownership. And that would be a $20,000 decrease in the investment account. Okay, that's a book value decrease. We didn't pay out any cash or sell any of the shares. In fact, we actually got some cash. Moving on to the next transaction. EQTY Limited reported $275,000 in net income. What will happen here is we will debit the investment in EQTY Limited common shares. Again, if you used an investment in associate account, you would debit that account. We will debit this for what amount? Well, we'll take the $275,000 of net income inside of the investee and multiply it by our percentage of ownership, or for a total of $55,000. We will credit equity method investment revenue. Or if you're using a slightly different set of accounts, you could credit investment in associate income or income from associate. The amount would be the same. Now, what does that mean? What is happening inside of the investee in this situation? Well, we know that in essence, the investee has income, so they would close their income summary of $275,000, and they would close that to retained earnings, wouldn't they, of $275,000. So if we were to take that $275,000 and multiply it by our percentage of ownership, we would get $55,000. If we are tracking the equity inside of the investee, if the investee's equity goes up by $275,000, then our investment account should go up by 20% of that. We weren't asked to, but let's take a look at what our investment account would look like. We have the initial $7 million debit for acquiring the shares, and then a reduction of $20,000 for the dividend. Then an increase of $55,000 to recognize the increase in equity of the investee when the investee had net income. Now we have a total book value of $7,035,000. And this would be the book value that would be used if any of the 2 million shares that we own are sold. That was a quick introduction to the equity method of accounting. I hope you found that example useful. So thanks for watching, and I'll see you next time.